Let's understand one thing first. Your monthly paycheck by itself won't make you wealthy. So what about savings and bonds then? No, they wouldn't be so profitable either. What to do then? If you are watching this video, you have come to the right corner of the internet, where we will dive into the world of stocks and investing. However, before anything else, kindly support this channel by subscribing. Now let's head back to the video. First, understand the term stocks. A security that indicates ownership of a portion of the issuing company is a stock. The term shares refers to units of stock that provide the owner a share in the company's assets and profits based on the number of shares they possess. In stock, you'll hear the word equity used frequently. It is the remaining ownership stake in a business or asset after deducting any debt related to it. The value that a company's shareholders would get if all of the company's obligations were settled and the company's assets were liquidated. Stock exchanges are the primary marketplaces for buying and selling stocks. Stock trades must adhere to government laws to safeguard investors from fraud, which makes it safe for the stakeholders to invest more and get profit in return. Corporations offer shares, or I may say stocks, to obtain money to run their business, and the holder of shares, known as a shareholder, may be entitled to a portion of the company's assets and profits. A shareholder is regarded as an owner of the issuing firm based on the number of shares an investor owns and the total number of outstanding shares. Isn't this interesting? Consider this. Suppose a business has 1,000 outstanding shares of stock, of which one individual owns 100. 10% of the company's assets and profits would be owned by and belong to that individual. Stockholders do not own corporations, but are considered legal entities by the law. Corporations pay taxes, allow borrowing, own property, and can be sued. Corporate property is legally segregated from shareholder property, limiting their responsibility. If a corporation declares bankruptcy, a judge may order the sale of all assets, but shareholder assets are not at risk. A significant shareholder must refrain from selling the company's assets to repay creditors. It is impressive to know that shareholders possess shares issued by the company, while the corporation owns a firm's assets. So, if, for instance, you declare you hold 33% of a firm's shares, you cannot claim to own 1/3 of that company. However, you own 1/3 of the company's shares. This is called the separation of ownership and control. So what advantage does having shares in a corporation provide for shareholders? Well, owning stock allows you to vote in shareholder meetings, receive profits as they are distributed, and sell your shares to others. So if you own the majority of the shares, your voting power increases, allowing you to indirectly dictate a company's direction by appointing its board of directors. This is most apparent when one corporation acquires another. The purchasing corporation buys all outstanding shares. Furthermore, the board of directors is responsible for enhancing the corporation's value, generally accomplished by appointing skilled managers or officers, such as the chief executive officer. Ordinary stockholders do not run the corporation. The essence of being a shareholder is that you are entitled to a share of the company's profits, which are the basis of a stock's worth. The more shares you have, the higher your percentage of the profits. Many companies, however, do not pay dividends and instead reinvest revenues to help the firm develop. However, these retained earnings are still reflected in the stock's value. Common stock owners are eligible to vote at shareholder meetings and receive dividends. Although preferred stockholders often cannot vote, they receive dividend payments ahead of common stockholders. They are given preference over common investors if the firm files for bankruptcy and liquidates its assets. However, common and preferred stocks may fall into various categories. Earnings in growth stocks are increasing more quickly than the average for the market. Investing in them is done with the expectation of capital appreciation, as they seldom pay dividends. A technological startup is probably going to be a growth stock. Income stocks regularly distribute dividends. For the income they produce, investors purchase them. A well-established utility firm is a stock that generates revenue. Because value stocks have a lower price-to-earnings ratio than other companies, they are more affordable. Value stocks are less expensive than companies with a more excellent price-to-earnings ratio, since they have a lower price-to-earnings ratio. Value companies can be growth or income stocks, and their low price-to-earn ratio might indicate that investors no longer find value in them. Purchasing value stocks is done with the expectation that the stock price will rise since the market has overreacted. Shares of big, recognizable businesses with a track record of consistent growth are known as blue-chip stocks. Usually they provide dividends. Let's get to the point now. The two ways that stock owners make money are through capital growth and dividends. A company's cash transfer of profits is called a dividend. So let's say, for instance, if a firm with 1,000 outstanding shares announces a $5,000 dividend, each share an investor owns will yield $5, and the actual rise in the share price will be known as capital appreciation. If a shareholder sells a share for $10 and the stock gains $11, they will profit $1. It becomes enjoyable to invest in the game once this technique is mastered. Throughout the 1990s, the four horsemen of tech, Microsoft, Intel Corp, Cisco Systems, and the now private Dell Computer, fueled the expansion of the internet industry and propelled the NASDAQ to previously unheard of heights, making buy and hold investing a popular strategy. Financial advisors suggested them to customers as companies to buy and hold for life since they seemed like such sure things. Unfortunately, many people who followed their advice bought late in the bull market cycle, which caused the values of these inflated equities to collapse along with the dot-com bubble. Despite these setbacks, the buy and hold approach pays off with less volatile companies, providing investors with outstanding annual returns. Before you begin pouring your money in, do some homework and find out what options suit you best. Purchasing individual stocks could be a great way to get into investing if you enjoy learning about markets and businesses via research and reading. If you're starting and have a small amount of money, consider purchasing fractional shares, even though the share prices of certain corporations seem very pricey. Invest in exchange-traded funds for stocks that follow an underlying index by purchasing numerous individual stocks. Purchasing equities from a wide range of firms in the same industry or that make up a stock index, such as the S&P 500, is similar to investing in an exchange-traded fund. Although exchange-traded funds shares are traded on stock markets, they offer a higher level of diversification than individual stock ownership. Invest in mutual funds with stocks. While mutual funds and exchange-traded funds have certain similarities, they differ significantly. The managers of actively managed mutual funds choose various stocks to outperform a benchmark index. When purchasing stock mutual fund shares, your profits come from capital gains, dividends, and interest income. Lower-cost index funds resemble exchange-traded funds in how they function as mutual funds. Remember that there is no right or wrong technique to make stock investments. Determining the ideal mix of individual stocks, exchange-traded funds, and mutual funds may take some trial and error. Certain companies let you purchase or sell their shares directly from them, negating the need for a middleman. Commissions are avoided. However, the plan may have additional costs if you move shares to a broker for sale. Some businesses restrict direct stock plans to current shareholders or company workers. Certain companies have minimum purchase or account level requirements. Direct stock programs typically prohibit you from purchasing or selling shares at a specific market price or period. Instead, the firm will buy or sell planned shares at the average market price at predetermined intervals, daily, weekly, or monthly. You can set up your purchases to be made automatically and have money deducted from your savings account automatically, depending on your plan. Plans for reinvesting dividends. With these plans, you can reinvest dividend payments into the firm and purchase more shares of stock you already hold. To complete this, you must sign an agreement with the company. Contact the business or your brokerage firm to determine if you will be charged for the service. For a commission, full service or discount brokers buy and sell shares on behalf of clients. Stocks can also be purchased through stock funds. These are a particular kind of mutual fund that mostly makes equity investments. Depending on investment aims and policies, a stock fund may focus on a specific category, such as blue chips, large cap value stocks, or mid-cap growth companies. Investment businesses sell stock funds acquired directly from them or via a broker or advisor. Every investment has some level of risk. If the state of the market deteriorates, the value of stocks, bonds, mutual funds, and exchange-traded funds may decrease. You have choices regarding what to do with your money when you invest. The value of your investment may increase or decrease depending on the state of the market or corporate choices, such as deciding to enter a new market or merging with another business. In the long run, historically, equities have performed better than most other investments. Profiting from the stock market is more challenging than maintaining it, as predatory algorithms and other internal factors create volatility and reversals that take advantage of the herd mentality of the masses. Since buying stocks is pointless if they yield less profit than real estate or money market accounts, this polarity draws attention to the crucial problem of annual returns. Even though history shows that stocks can yield higher returns than other assets, risk management and strict discipline are necessary for long-term profitability to prevent traps and sporadic outliers. Sure, investing in stocks can yield substantial returns and provide wealth, but buyers must overcome structural, psychological, and financial challenges. The best route to long-term success is to choose the best stockbroker and focus on cash accumulation before expanding into new ventures. The most enduring investment strategy for most market participants is buy and hold. Short-term speculating and short selling are only two tactics the minority with exceptional talents might use to produce greater returns.